Man, I have not posted on this channel in over 2 years. It's crazy. But today, I am going to be making a video on the top 6 banks in Canada, obviously the big 6 banks, and which one is the best investment right now, especially with how crazy the world is right now. And so, let's get down and let's really check this out, because things have changed up quite a bit since the last time I made these videos. And it's not just the fact that I gained 100 pounds and need a shave, but either way, let's get down and let's check these out. Okay, so by looking at CIBC, which is the ticker CM, there's a few things that really pop out. So back the last time I made these videos, the dividend percentage was much higher. It's only at 2.9% right now. Price to earnings is something that we usually look at quite a bit as well, and it's at 15.8. So when we start looking at the actual chart itself, there's a few things that really catch my attention. And that is the trends that are happening over a 1 year, 5 year, as well as a 1 month or 6 month time period, or even 5 days. So a few things that tend to happen. Right now it's trading, at least on the trend line, it's trending actually quite a bit lower than what it generally has been in the past. I actually kind of think that it could go up a little bit more in the near future if we continue along the trend line right here. But there's a few things that we also have to keep in mind as well. So right here, if we look at this kind of a trend going up forward here, there was a dip over here and it broke out of the dip there. However, another thing that I really look at is the fact that, yes, there is increases, and then it kind of trades sideways a little bit for a bit. Goes up a little bit, trades sideways, goes up, and this time it went down. Traded up again, now it's trading sideways. This is kind of the trends that I look for in the Canadian banks, because they've been around for so long. They're not a investment where you would be trying to basically get in before a massive uptick in their stock price. They're a pretty stable business, and they're not going to be doing massive improvements on their earnings every single year. It's a bank. It's a boring investment. Now, this is the thing that I really look at too, and that is the 5 year and how far it's gone up over the past 5 years. 137%. So you've over doubled your money if you invested 5 years ago. But check out this uptick right here. This is actually quite interesting because obviously there's been a lot of money printing all the way to this point. But how is the fact that these stocks continue to go higher even though there's a war going on that tends to get some pretty bad press, at least in mainstream media? But in reality, who really watches mainstream media anyways? They just bug me. And right now it's pretty much trading at an all-time high or close to an all-time high, and so you generally never want to get into a bank stock or a Canadian bank stock at a 52-week high. Because as we can see right here, the 52-week high is 151.60. It's currently 151.57. Let's call it what it is. It's a 52-week high. You never get into a bank stock on a 52-week high unless you're coming out of COVID, which we all ran that one up. You've seen my videos on this channel. Going over to National Bank NA.TO for the Canadian version, you're seeing a very same chart. Pretty much the same increase, might as well say 130%. And the dividend is 2.47%. Its 52-week high is 205.50. It's currently sitting at 205.04, so pretty much a 52-week high. And the PE ratio, if my iPad wants me to zoom in, is 19.7. So price to earnings wise, National Bank of Canada sucks versus, or at least as an investment, sucks versus the CIBC stock that we were just looking at. If we look at a 5-year chart of Royal Bank of Canada, 108%, so not as good of an investment as the others over the past 5 years. Its PE ratio is a little bit lower than the last one at 16.7, and the dividend is slightly better at 2.7%. Again, it's pretty much at its 52-week high, $2 less than its 52-week high. So yes, technically this would be a slightly better investment than the other banks we've looked at so far, mainly because it's a lower PE ratio. It's slightly off of its 52-week high, and it has a slightly higher dividend. When you start getting into the Canadian banks, you're going to try, or at least I would advise, I tell everybody to try and invest in Canadian banks when they have a low PE ratio versus the other big six, and a higher dividend versus the big six, but also look at the 1 year and the 5 year percentage, the increase, because you're going to be able to see which bank is favored over the other, and you generally don't want to go into the favored banks at that time. You generally want to get into the banks that are not as favored, because they're going to have a higher increase of stock price over the future versus the others will eventually stagnate. They all kind of bounce around the same number, but when you start looking at the ones that are unfavored versus the ones that are favored, you're going to have a better increase in your actual income, your earnings from the stock price itself, if you go with the ones that are least favored. TD would be a really good example of this, because we can see that it's 52-week high. It's right pretty much at the top. 146.40, 146.33, pretty much at a 52-week high. But if we look at the actual 5-year charting at 73%, it's gone up less than the others. It has a 3% dividend, which is much better than the others. And if we look at the PE ratio, it's down at 11.8. In fact, I made a video a little while ago, I'm pretty sure I said that I would never invest in a Canadian bank that's over a 13 PE ratio. Pretty much a lot of them are right now, but TD is not. So to me, it's looking, with just the numbers wise, not even looking at the chart, it's looking like a better investment in my eyes. Now, if we look at the 1 year increase of 66% versus the 5 year that was just over 70%, you're going to see that most of the increase to the 5 year actually came from the past year itself versus the others that are not as close as that, which means that it's starting to turn around. It's starting to become one of the favored stocks. So this would be potentially a little bit better of an investment. If we start looking at how the trend lines actually work, we're going to see that those higher lows right here as well as right here, they were kind of trending along that line. Now, if we add in a couple of lines right here where we kind of see from this point moving up, oops, I thought I had the straight line on. We can see that from this point here to this point here, versus the trend, we're going to still show this because that is what looks to be a potential double bottom, but I would have to zoom in a lot more to be able to see that part to make sure. However, it is a pretty clear double bottom from at least the 1 year view. You can see that this has not topped out here yet, but it has not fallen below here yet, which means that potentially we could be looking at a stock that could have a potential run of about over $150 per share or more, depending on where that stock chart wants to go. But then again, if we look at the 5-day chart as well as the 52-week range, it's still at the highest point like all of the other banks. Bank of Nova Scotia is also quite interesting, BNS.TO. They're 5 years, 35%. When we're looking at the PE ratio, it is quite a bit higher than TD, but it has a higher dividend as well of 4.25%. There are some issues with the stock chart itself. Obviously, there was this dip. While all of the other banks were trading like this one dipped, so there is an issue with this stock. It's going to be interesting if it can break through this point right here. If it does, it could run quite a bit. In fact, right now, how I look at this chart, if I look at just this 6-month chart, if it breaks through the 52-week high, so the 52-week high is 106.39. If it can break through that and stay above that for a few days without running substantially, this could actually be a very interesting stock to be able to get into for the short term, but for the long term as well, because it's definitely not a favored stock. Obviously, its earnings are not that great its earnings versus its stock price is also not as great as TD. So keep that in mind when you're looking at Bank of Nova Scotia, BNS. BMO is another one with a very high PE ratio. It also has not a bad dividend of 3.29%. PE ratio is 17, which is huge. We're looking at the 1-year chart right here. Remember when I mentioned the dip? This one doesn't have that big major dip as BNS. Its 5-year chart, it's up 78%. Obviously, a lot of that coming over the past year to year and a half. But remember how all of the other stocks, all of the other banks, Canadian bank stocks, were moving up like this, while this one, for almost 5 years, traded pretty much sideways. This, obviously, because it was a least favored stock, would have been fantastic to get into at this point. However, in my opinion, BMO with a 17 PE ratio, even though it's got a higher dividend, or one of the highest dividends out of the big six, and yes, it has gone for a run over the last little bit, this still is not this would be not a stock I would be interested in. Even though it's a least favored stock, its PE ratio is way too high, and the dividend is nice, so overall, I would personally stay away from this one. Before I give my advice as to which stock I would personally buy right now out of the big six, I'm going to say that I do banking, or I might do banking at this bank. However, it is not a bank that is paying me for this video. This is my own advice. Remember, you should never take advice from a random person online like myself. So there's my legal disclosure. But from there, TD would be the stock that I would be looking at because it has an 11 PE ratio, which is the lowest out of the big six banks. So right now, the 5 out, or I would say a good 5 out of the big six Canadian banks, the price of their stock is inflating more than what their earnings are currently doing versus TD, where it's at an 11.8, which is not that terrible. Back 2-3 years ago, before I stopped making videos on this channel, a PE ratio at a Canadian bank of anything below 10 was phenomenal. Anything above 10 was really bad. But now with how the world is, this is where we're pretty much at. So if I was to buy out of the big six, TD would be the one. Even though it doesn't have a massive dividend, it's got the third highest. It's sitting right in the middle. It does have the lowest PE ratio, which means that it shouldn't get hit as hard as some of the other banks if there is a downturn in the market. Or if there is an uptick in the Canadian bank market, then they would probably have the biggest range to run, at least from historical purposes when it comes to Canadian banks. Anyways, hit that like button, subscribe, and I will see you guys again in my next video. I promise I'm going to make more.